Hello everyone and hello Shakti. Today we're going to talk about some analytics on stocks market, and that's going to be 100 years of history. Why? Because lately Shakti has mentioned something that drew my attention. On average, during a 30 years period, S&P 500 gives you a return of 8% annually.
Yeah,
And what it means 10x.
that's the bare minimum we have noticed in the last 100 plus years.
Yeah. If you invest $1 30 years ago, today you will have at least $10 from
Yeah.
that dollar. Okay. That's good to know. That's great to know. And I was just trying to kind of figure out the math behind that, and I could match your numbers. While I'm sharing my screen, I want to remind everyone, please like, share, and subscribe. And we'll be super grateful. A quick analysis. So basically, you have $1 of investment. Here we have $1 of investment. Here we have 8% of average annual return, right? So, and then let's go year by year. After 1 year, 1.08, 8 cents. Then next year, it is compounding, right? That's why it's going to be plus 17 cents. And then plus 26 cents. And on and on and on and on. And then when we reach 30 years, that's going to be $10. Am I right? Is the logic correct?
If you go beyond 10 years, you start noticing the major difference. So between year 1 and 10, the dollar one became 2, right? It just doubled. But between 10 and 20, you notice that the dollar one gave you more than what it had given in the first 10 years. But the real difference occurs after year 20. From 21 to 30, you notice that it jumped from 5 to 10. So you got $5 for every dollar that you invested in the beginning of this whole cycle. So the magic of compounding occurs exponentially faster in the last 10 years. So that's where patience makes a huge difference. If we can
Yeah.
stay on for the long run, you would see major improvement in your returns. Yeah, that's a real example. And if you scroll further, you'll notice even bigger jumps. And that's one reason why I think Warren Buffett has more money than any other investor, because he started way long, way early. And if you expand to 50, 60 years, that $1 has become $100, right? It's 100x return that you get if you wait for 60 years. That's how you build generational wealth. If we start now, in 60 years, we will have 100x our money. But it's just that we don't have time on our side. And that's that.
Give me time. Well, but this is the worst case scenario.
That is the worst
It's
case.
like being very pessimistic.
So this one applies to 1929 during the Great Depression. If you had put your money at the peak and the market crashed by 80%, even then you get 8% if you wait for 30 years, right? But after 1960 or so, the market has been returning close to 9 to 10% every year. So you can use 10% as your baseline to be
Okay,
more
let's do it.
in line with the recent trends.
17 times. Look at
Yep.
this.
That's a huge difference.
17 times.
Almost double of what you would have received for 8%.
That's amazing. And if I wait, like let's say it is not 30, but okay, let me see, like 40 years.
Yeah.
40 years,
That's
45
45 times.
times.
Actually, 40 years is a good number for most investors who are starting young. So if you're 20 years old and
Yeah.
you're starting your investment journey, then
Yeah.
makes a huge difference, because you retire at 60 and you can make 45 times your original investment. More than me, who's close to my 40s, someone in their 20s have a better chance of making more money. That's why we say get into investing as soon as possible. I wish somebody told me this when I was 20.
Well, let's look at the history return of S&P 500. We have gold and we have US Treasury bonds and return on real estate. This is last 100 years. And you probably see only return on S&P 500. But that was not always the case. Let's look at 30 years window, right? So that's gonna be something like this. Here we go. Okay, Shakti, this is that 10x that
Yeah,
you were talking about.
that's the worst case.
And this is the worst case. Okay, if I move a little bit, that's
36,
and then move a little bit more.
35. Great times to invest those years.
Yeah. Well, here it is slightly less, 18 times. What about, oh, look at this. During certain times, if you invest in 1954 and looking at your return, let's say in 1980, then you would be better off with gold.
Yeah. It's
Hmm.
a very unique scenario that which happened within that window. You're not going to be doing much worse with stocks. They're still fine. But gold had a real jump during that time and immediately it crashed, if you can see the chart. So
Yeah.
probably highly valued at that time and then just dropped.
Yeah.
This is
Eh,
great. 46. Did you see the 46? At some point, you could have made 46 just within 30 years.
What do you think then about US Treasury bonds and real estate? And like, let's say we will minimize the window slightly and look at 20 years overall.
Yeah, when you look at 10 or 20 years, you would always find that the other assets are pretty close. Stocks do well on a 30-year time frame. The compounding effect of 6% is much lower than the effect of 8%, and it's
Yeah.
much lower than the effect of 10%, which is what we are seeing in the last 50 years or so.
What then about bonds? Does it make sense to invest in bonds, or it doesn't, seeing that okay, you don't get that much return from bonds as you get from stocks market?
Bonds will not give you similar returns, but if you are already retired and you want to play it a bit safe, if you are investing in short-term maturity bonds, even though the interest rates fluctuate, the bond value will not fluctuate that much. This applies only for short-term maturity bonds
Yeah.
while you are in retirement. And in that case, if the stock market suddenly crashed for 50% or 60%, and if you're taking money out of that fund for your monthly expenses, then it makes sense to have bonds which can support you during the crash. Let's say you had a 70-30 percentage, 70% in stocks, 30% in bonds. Now,
Mhm.
when the market crashes by 60%, your 70% stock goes down a lot. You don't want to be taking money out of that 70% pool for your daily expenses. In that crisis situation, you can use the short term maturity bonds and use those that 30% until the market recovers. So it's like
Yeah.
just a safety net during crashes, but it doesn't apply if you are young. You're anyway not going to use that money.
Yeah.
So I would rather have all my money in stocks when you're not retired yet.
Yeah. So it's like, for example, this case of 2008 market dropped down significantly,
Yeah,
and that's when bonds were returning more.
it doesn't matter if the bond returns or not. And also, I'm talking about U.S. government bonds, right? Not some
Yeah,
random corporate bond,
that's
because even
U.S.
corporate
Treasury
bonds
bonds.
crashed during market crashes. The U.S. Treasury bonds, short-term bonds, they may not be giving you any return at all, but still it is like better than cash, better than holding cash, because it will still give you the current market interest rate, which can compensate for the high inflation. So let's say if there is high inflation,
Yeah.
if you are holding cash, you are losing money. But if you are holding treasury bonds, the bond will give you that yield, that inflation, so that you can adjust that inflation and still hold the value of your money.
Yeah. So what would be the strategy in 2008? Take money from bonds and put it in stocks while it's cheap.
This is not something you do after the fact. You are already prepared. So if you are retired, you're already prepared
Yeah.
with 30% bonds. And if crash occurs, then you implement the strategy. You don't change your strategy while the things
Yeah.
are going up and down.
Yeah. Yeah. Okay, that makes sense. That makes sense. And what about real estate?
See, real estate, I think from the data I've seen, one good news is it doesn't crash significantly even during bad times
Yeah.
because it is held up by people's belief system that they shouldn't sell their house even during crisis. When it comes to stocks, if there is a crash and people hear that in the news, they would immediately go and sell their stocks. So the crash will be much faster. But for real estate, even though the real estate market goes down, it doesn't mean everybody will go and sell their house while that's happening. They'll probably be
Yeah.
sad, but they'll be looking at the news and holding that asset. Since they're holding that asset, the crash is lower. Even though the growth is not comparable to stocks, it's hardly 6% every year, unless you invest in some real estate location which suddenly booms, which is very rare. In most cases, you get only 6% or so. But the
Yeah.
crash might not be as bad as the stock market because people are not in a hurry to sell everything. Right?
Yeah. Yeah.
And leverage. If you want to own a real estate property, the bank will give you 5 times or more leverage. I think in some cases 20 times, right? So you put 5% deposit and you get $1 million house for just 50,000. And that leverage is something that is not offered over a very long period for stocks. You get a 30-year leverage for housing, while you only get probably 2-year leverage using options trading or whatever. So which is much more riskier. Though leverage is risky, at least the time frame is 30 years. Technically speaking, if you are able to work for the 30 years and pay the mortgage, you get better returns because you have leveraged your money. It's gambling, but safe gambling. So,
Yeah. Yeah. I see. But overall, in 30 years time frame, according to the last 100 years of data, S&P 500 in particular was performing better.
also, a couple of points to note is for real estate, in the 30-year mortgage period, if you lose your job or you have bad health or whatever family situation, if you are not able to pay the mortgage, you lose the house. But in the case of the stock market, if you are holding the S&P 500, irrespective of whether you have a job or not, if you don't sell it, it is yours, right? You manage your expenses with other means because you are not obligated to pay for the mortgage, right? So that's the pro and con of holding stocks and real estate. And within stocks, S&P 500 will keep the winners and remove the losers. So if you look at the
Yep.
top 20 companies in the last 100 years, it is always fluctuating. It's not the same, right? But
Yep.
you always hold the winners in the market, and that's why it has been growing as it has been, irrespective of all the challenges that we face every day. Yeah.
That's cool. That's very interesting. Maybe quickly, the last thing, we did talk about bonds. We did talk about S&P 500, gold, and all these beautiful assets. And I'm just wondering if we can look at it using our platform, StocksDojo. So you were mentioning bonds, short-term bonds, or all the bonds. Which ticker is going to be?
Vanguard total bond market is something that many prefer because it's a combination of multiple bonds and different maturity periods.
BND.
Yeah.
That's the one.
Yeah.
Vanguard total bond market. That's gonna be everything: short, term, long term,
I
government,
believe it's a
corporate, everything.
combination corporate. Yeah, it's like, but and the returns are decent if you look at a long term perspective,
Like 10 years, let's
or
say we
even
look at
when you say all. So the within 10 years,
all.
we have noticed this huge curve because during COVID, the interest rates were increased as inflation followed. And when interest rates rapidly increase, these kind of bonds, which are spread across multiple diversified maturity dates, are bound to crash. And that's what happened here.
I'm quite interested in this point, and
Mhm.
if you can explain that little bit more in details, how interest rate and bonds are interconnected.
Yeah. So when you initially buy a bond from the market, when is the first issue, you will
Yeah,
get the face value and the corresponding interest rate. Let's say now buy a bond for $100, and the interest rate is $4. So I get $4 for $100. But the bond
yeah,
market is liquid, and you can buy the same anytime during the maturity period. So if the maturity period is 10 years, I can even buy the bond 2 years after the initial issue. And during
yeah,
that time, if the interest rates have changed, like in this case, if you are holding that bond to match that new interest rate, the bond value will drop. And that's why
yeah,
people will see a change in their principal amount if the interest rates go up. But if you hold that bond for 10 years, you will get your interest principal back. But if you're selling it before 10 years, you will be subject to ups and downs in the principal value based on the change in the interest rates in the market. That's why I said if the bond market or the bond that you're buying is short-term bond, let's say
Yep.
for 3 months, the principal
Yep.
value will not fluctuate that much because the interest rate is not going to change rapidly within 3 months. But if you're holding something for 5 years or 10-year maturity, you
You don't
are
know.
bound to lose your principal if the interest rate goes up. And that's what happened here. And now it's
Yeah.
slowly recovering because interest rates are coming backwards, right? It's not, they're trying to cut the rates. And as long as they keep cutting rates, this value will go up.
Okay. So, one step back, last question, or maybe not last, another question. What is the difference between bonds and stocks?
So, stock, you're just owning a piece of a company, right?
Yeah.
So, you become part owner of the company. And it's mostly, we are talking about companies which are publicly traded, not private ones. That's a different
Okay.
story altogether. When it comes to bonds, those are again issued either by corporates or by governments for whatever reason. You're technically funding the issuer. So if you're buying a corporate bond, you're funding
Mm-hmm.
the company for whatever initiative that they are going to work on. And for that, they'll give you some interest. It's all about borrowing money from you and providing some interest to you from a high level perspective, right? The same applies for government bonds. Corporate bonds are a bit risky because they're bound to default if the company goes bankrupt. But US treasuries are supposed to be safe because it's a US treasury, right? So if I am investing, I would rather invest in US treasury. But the interest rate for US treasury might be lower compared to corporate bonds because corporate bonds have higher risk. This BND, I think it's a mixture of stuff. I believe it's a total bond market, as the name says, right? So it will include multiple risks in it. But if you want the safest option, you can search for SHV, which is something I recently bought. It kind of meets my safe short-term
SHV.
V. Yeah, iShares
Wow.
short-term treasury bonds. Now, if you look at this one and look at the chart over a 10-year period, I don't know if they have 10-year chart. As you see,
And it's
the
just a
value has
straight
never
line.
dropped. It is only going up. It won't go up that much because it's a short-term bond. But overall, whatever you see in the beginning has never dropped in between. So if you want your
Okay.
principal to be intact and still get some interest rate, this is the best place to do it. Can you check the dividends? The dividends will actually tell you how much interest you were provided. Yeah, if you see the dividend yield, it was 5% end of 2024. One of the best times because the market interest rate was 5%. So on and so forth. And it was like very low during 2020, like 0.69. So this is an
Mm-hmm.
indication that this value will fluctuate rapidly, but your principal amount will remain. And this is what I would want if I retire rather than even BND. BND is total bond market. And as you saw, there was a crash. I don't want my money to crash during a recession.
Yeah, that makes sense. Well, that's cool. So it's basically a quite interesting place to be. We can be company owners or we can be lenders and lend money to government or corporations. That's
Awesome.
exciting. Yeah. Well, thank you very much and talk to you soon. Bye for now.